Introduce myself, and Patrick already told you who I am. I'm Randy Carlson. I'm an employee here at Hiway Federal Credit Union. I'm actually the manager of business services. I've been manager here or working here for 2 years. Prior to that, I have 30 years experience in the banking industry. Worked at several banks throughout the metropolitan area, and even got into what I call industry financing. I worked at North Star Steel as a credit manager for a number of years, and here I am back in the banking, so to speak. I'm at a credit union. I shouldn't say banking when I work here, and totally enjoy it. So what I'd like to do is, first, before we start, is I would like to make an announcement here that it is Hiway's actually 80th anniversary here, so I'd like to congratulate them on being in business for 80 years, and just to show you the rest of you. It's been in business just as long as Hiway has been. Okay, having a strong positive cash flow is a major player in the process of developing a successful business. You may do this, you may ask, how do you develop a strong cash flow? Well, there are many ways to do that. There are a couple of steps. First is develop a business plan. You want to start a good business plan, and it provides a good model for follow-up and helps create goals you want to achieve. Remember, a business plan is a work in process. That is, it evolves as the business changes, and it grows and changes as the business evolves. Knowing where you are and where you're heading is essential to a solid business plan. This is the beginning of the foundation of building a positive cash flow. What makes a good business plan? First, you want to look at, does it fit the business need? Has the plan achieved its business purpose? Is it realistic? Can it be implemented? Is it specific? Does it include tasks, deadlines, dates, forecasts, budgets, and measures? Does it define responsibilities? All tasks should have its owner and the person responsible for it. Does it clearly show assumptions? Now, you have to remember that business plans are actually a guess into the future. So assumptions need to be made up front to follow for changes or adjustments to the plan. It is also communicating to people who run it. In other words, is the plan manageable? It is getting people committed. Is everyone involved working on a team? And last of all, is it being kept alive? In other words, are you reviewing the plan on a regular basis? Now, there are many sources that can help you with getting a business plan. One is the Small Business Training Network, which is an online service that is offered by SBA. You can go in there, and it has good training sources for you to learn a little bit about the business plans. Another source is the Small Business Development Centers. They provide management assistance to current and prospective small business owners. And of course, the one that probably everyone is most familiar with is SCORE, which is also otherwise known as Counselors to America's Small Businesses. Then there's the Women's Business Centers, and they help women entrepreneurs who are economically and socially disadvantaged. And lastly, of course, there are the SBA district offices, and there are offices located in every state in the country. A second step to developing a strong business or cash flow is developing a good relationship with your financial institution. Financial institutions provide you with many services, such as setting up a checking and savings accounts. This gives you a place to keep, maintain, and manage your money. Financial institutions also offer other saving tools such as certificates of deposit. As your business grows, you begin to develop cash, excess cash, and need additional sources to deposit your money. Financial institutions also provide access to additional sources of funds, such as loans. A line of credit is one type of loan you can obtain. It is effectively an account that can readily be tapped at the borrower's discretion. Interest is paid on the money actually drawn, and it allows the principal balance to be paid down, giving the borrower additional availability to borrow up to the limit that was granted. Financial institutions also become your partner. While you are become the expert in running your business, financial institution will work with you and show you how to be your advisor in growing and handling your money. I kind of like to go into and explain a couple of definitions, or explain what actually cash flow is and how to calculate cash flow on a very simple format here. First one is, what is cash flow? Cash flow is simply the movement of cash in and out of a business. I mean, that's as basically as you want to put it. There are a lot of different definitions of it, and it gets pretty quite detailed, but that's essentially what cash flow is. And here is an example of, a simple example of how cash flow works. First, you want to start out with your cash. From there, it creates the inventory, which you produce your product and make your sale, which comes to your accounts receivable and back again to cash, and the process continues on and on again. So that's kind of how a simple cash flow process works. Next thing I'd like to show you is how to calculate cash, and I'll just kind of hit this on a brief side. I won't go into in too much detail because I'm sure one of the other speakers would be more inclined to talk more about that. First thing you want to do is start out with net income after tax. Then you want to add back any depreciation that you have. Now, in case you don't know what depreciation is, it's allocating the cost of tangible assets over the useful life. Then if you have any amortization expense, you want to add that back in. And amortization expense is the portion of an intangible asset that is being written off for the year. You'll also want to add back, if you have any, depletion expense. Now, what depletion expense is the cost of natural resources sold. Not a lot of companies will have that expense. And then finally, you want to add back in your interest expense. What you do end up with is cash flow available to service the debt. And of course, that's where you want to keep it at a positive. You don't want to end up using all your money, especially your first dollar earned, like this business has. Whether it is a multi-billion-dollar empire such as Bill Gates, or the tiny mom-and-pop convenience store located in a street corner, cash is the lifeblood of the business. You certainly do not want to have any leaks in your pipeline. What cash flow really is about? It is about fast collections. You may ask, how do I do that? Well, first you want to speed up customer orders by having them fax them to you. Secondly, you want to send out invoices the same day they are shipped. Thirdly, indicate when payment is due on the invoice. You might even want to put that in bold so they can see what the due date is on that invoice. And then lastly, you want to consider using a bank lockbox. Cash flow is also about depositing checks fast. You always want to deposit your checks on the same day you receive them. And believe it or not, you can work with a bank and try and get availability from 0 to 2 days. There are some institutions that will do that. So always be willing to bring that up when especially when you're going out and opening up a new account or something like that. You may want to just ask them about that, what their availability time is. and try to negotiate the time with them. A lot of them will actually negotiate with you. Another thing you don't want to do is use automated teller machine or night depository for your deposit. What happens is the deposit probably won't be credited until the next day or maybe even the next few business days afterwards, depending on when you deposited your money into the night depository. Finally, you want to know the availability on the deposited checks. In other words, what is the absolute latest time in the day that you can make a deposit and still get it credited that day? So those are all things you can check with your financial institution. Cash flow is also about having a tight accounts receivable policy. And here are some examples of how to develop a tight AR policy. And I'll just go over these briefly because I know somebody else is going to be talking about more about AR stuff. Do credit checks on all customers before offering credit terms. Ask for references on new customers. Don't offer too generous of discounts. You may want to look at charging late fees, and of course if you're charging late fees, you want to collect the late fees. Don't ship out orders if bills aren't paid. And instruct your financial institution to automatically deposit return checks. A lot of times they won't do that, and they'll send the check back to you. If you have them redeposit it, it gives you a little extra time to use that cash that you've already deposited into your account. And finally, you want to institute a policy of cash on delivery on slow paying customers. Cash flow is also about dispersing your money slowly. You want to try to keep your money as long as possible. Pay your invoices on the last day they're due. Another thing you might want to try and do is make your payments on a Thursday or Friday if possible. That gives you the weekend to give you a few extra days on your cash flow. Use business credit cards for travel, lodging, and small expenses for yourself and for your employees. Don't issue advances to employees. And don't keep extra money in a financial institution. Now, for somebody that works for a financial institution, you're probably wondering why I say that. It is good to keep money in the financial institution, but if you have extra money, it's best for you to use that to pay for expenses and reinvest back into the company versus going out and borrowing it. Although borrowing the money is also another option that you may have with when you are in lack of cash. Cash flow is also remembering inventory is not cash. Be accurate on forecasting when inventory will sell. Determine how fast you can get inventory. And again, don't order too much inventory. And you want to shop for the best prices. You don't have to use one vendor all the time. Use multiple vendors and try to get the best price you can. And lastly, move obsolete inventory out. And finally, what cash is about is the use of continuing sales. What that is, in other words, what that is have a contract set up where you can purchase products or services on an installment basis. In other words, get terms with your vendors or suppliers. Every business has its ups and downs. As in recent years with the major downturns in the economy, many businesses have found themselves with lack of cash. How do you prepare yourself to manage shortfalls? First off, you want to obtain a line of credit or short-term loan from the financial institution. Secondly, and you want to do that you want to be proactive on doing that. I mean, don't wait till you're in dire straits to go to your financial institution and try and get the money. Be proactive with that. Do it in good times, even though you may not need it, especially a line of credit. Have one available for you. Doesn't mean that you have to use it. It's there for you, and it's actually going to be easier for you to get it when you're in good times versus when you're in dire straits. Another way to manage shortfalls is to extend credit terms with your vendors. And again, this is kind of like getting a short-term loan with your bank. You extend the length of time that you have to pay them back, you can use your money a little bit longer. Another way is to ask your best customers to accelerate payments. You may even want to offer a discount for early pay. This will help you get cash in your hands quicker. When things are really tough, you want to consider selling and leasing back assets such as machinery, office equipment, computers, phone systems, and that way you get your money for selling them back, and then the lease is usually a little bit cheaper to lease back the assets, so you can save yourself some money that way. And also you want to figure out choose how to pay your bills. You will first want to make your payroll, keep your employees happy, and then you want to look at crucial vendors and pay them next. Don't find yourself like this business, where they're spending too much time paying bills. The goal of good cash flow is to have enough cash on hand when you need it. This is a simple concept. Make sure money is coming into a business and going out. Many small business owners do not give cash management a second thought, and that leaves them vulnerable to all kinds of cash dangers. Learning good cash flow techniques, as I have explained, ensures that a company always has enough cash to meet its obligations. A shortage of cash flow could result in loss of vulnerable trade discounts, possible financial embarrassment, and even bankruptcy. Thus, the power of good cash flow. In closing, I would like to share with you a saying that I use, believe in, and has been stated by many others, and that is, cash is king. Thank you.
Randy, quick question for you. How important is cash flow when people come to you wanting to borrow money?
How important is it? It's very important. Usually that's one of the things that we do look at is how the cash flow of a company is, how successful they are, and can they service their debt? That's, we calculate it out, we figure out what, where our company would stand as far as can they service debt. We have ratios that we certainly do look at when we do all the calculations and everything. But yes, it is very important that a company does cash flow. And that's why I say earlier in my presentation I mentioned that go out and get those credit lines or short-term loans while your business is prospering. It's a lot easier doing that versus when you're in dire straits and trying to go out there and get money. Because you're not cash flowing, credit unions or banks are not going to look at you and say we can't service your debt, so they're not going to be able to handle it.
Okay, thank you.
Thank you.